Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of Investment Friday on the Expansive CEO podcast. I am your host, Hannah Chapman, and I am here as usual, but not always, with Brad Haines, Chief Investment Officer of Juncture Wealth Strategies. And it is Thursday, January 18th, right now, as we record this for release on January 19th. Brad, what's up, man? How's it going?
Good. It's going really, really well. Yeah. Finishing the holidays, getting right back to it, getting right back into the economy, the markets, geopolitics. We got a lot going on. And it seems like 2024 is going to be an interesting year, to say the least. Whether it's good or not will remain to be seen, but for sure, it's going to give us our lots to talk about from all those standpoints.
Yes, absolutely. And I want to remind listeners that we put out the 2024 look ahead. If anyone still wants that, you can email either of us to get a copy of that, kind of a recap of last year, and then what are the things that we're looking at from an investment standpoint for 2024. So you can email me at Hannah, Hannh.Chapman, Chapman, at X, the numeral 2, wealthplanning.com. And Brad, how can they get you?
You can get a hold of me, Brad Haines, or B Haines, Bhaines, at juncturewealth.com. Just a case of note, I have received a few emails from some of our listeners and viewers out there that I have not responded to yet, so I apologize. But I am getting to those emails in the next day or two, and you'll have a copy in your inbox.
Awesome. Perfect. Yes. So from there, launching now back into, we did a couple of cool episodes that were a little bit more like, how do we look at risk and how do we, look at a full year in review? What do we expect for politics and markets together in 2024? And now we're kind of getting back into the swing of, trading and regular investment talk. So how are things going so far in January? And what are we looking at right now investment wise?
Yeah, so this year has started off a little rockier, which is not unexpected given the really strong, last 6 weeks, last 10 weeks of 2023, where the first 9.5 months of 2023, essentially 8 stocks drove the entire return of the broader indices. Well, you know, ever since Jerome Powell made that pivot of where the Federal Reserve might start looking to lower interest rates in 2024, all the investors rushed into assets that were beaten down, small cap real estate, regional banks, and those assets appreciated significantly in a very, very short period of time of 10 weeks. And so the first couple of weeks of this year, you've seen some of those assets settle back a little bit, come down a little bit. A great example is essentially small cap stock was up roughly 20% in a 10-week period at the end of the year. And it's down 5 to 6% in terms of the first couple weeks of January. Again, nothing goes up in a straight line. We should expect some volatility given those situations. And so that's kind of where we are right now, is what really did very, very well in the last 10 weeks of the year, has kind of settled back a little bit. Again, not very badly, just a small little normal course of business volatility. And so far from what we're seeing, the themes of 2024 are still in play.
So with that, we wanted to talk today a little bit about kind of overall trends and what that looks like, the volatility within trends. And so one of the things I like to remind, clients about when we're looking at, hey, there was a run up. So small cap stocks, for example, right? Juncture, we're like in small cap in our portfolios as an important aspect. And when things run up that much, so you said 20% in 10 weeks, right? For the small cap index, that is always going to, maybe not always, we shouldn't say always or never, right? But most of the time that's going to end up with people taking profits off the table. So if someone bought something, what is that, 14 weeks ago, it ran up 20%, you're going to have some profit taking coming off the table, and we're going to see some resettling in that regard. Is that what you see also, or what else would you call that?
Absolutely. Absolutely. So that's a little variation with a trend, right? So any trend, any time series, and by what I mean by time series is any data, any data that comes in where time is a factor. So price of stocks. Um, those are very, very time, they're dependent because it goes through time, right? So that's a time series. Um, Anytime you have a time series, there's going to be some volatility or variability within the larger trend. In a bull market, we go from point A to point B, which is much higher, but you have little corrections, little bounce down and up above that trend line. And that is completely normal, really very, very normal, nothing to worry about. Um, and so we've seen that in the first couple of weeks of this year, where, for example, if you take CPI, consumer price inflation, it's how people measure, it's one of the more popular measures of inflation for the United States consumer. Well, we've decelerated or disinflated from 9% at its high to now a little over 3%. So that is a larger trend of disinflation, inflation coming down, the growth of inflation coming down. But last week, we had an announcement that the CPI had gone up a little bit more than we had anticipated. Still pretty low, very, very low relative to the peak, but it bounced up a little bit. So then it caused a little consternation with some of the investors saying, wow, well, maybe inflation isn't dead. Maybe the Federal Reserve may not lower interest rates as aggressively as we thought they would in 2024. So it starts to have people reassess the positioning of their portfolios and to see what they need to do to react to those types of situations. Um, all very, very normal. Our trends that we put out in 2024 for the year ahead are longer term in nature. But I did remind people that we may have fits and starts in any of those trends, whether it be, the economy, economic growth, inflation, stock price appreciation, bond returns. So it's a normal course of business, but it gives us good opportunity for long-term investors to step in and buy some things that they are still inexpensive.
And so I love what you mentioned about the time series, and in looking at returns over time periods, right? That's really the way when we look in a financial planning meeting, when we're looking at what is the trend forecast over time. A lot of times, and even in the software that I use, a lot of it uses a straight line model, meaning, okay, we're going to average 8% or 7.5%, whatever you're choosing to um, as a rate of return over time. And so, if you have $100,000 today, it's going to go up in this pretty straight line at 7.5% per year over your lifetime, and you'll end up with, multiple millions of dollars. One thing that can give people is that literally that false representation of what actually happens in the markets over time. And so another way that I actually like to look at that, we have another setting in our financial planning software that we use that shows, okay, what happens when it's variable. And so you can see sometimes the portfolio drops in a year, and then it goes up a lot in another year, and then it drops again. And these are all still based on historical averages, but it's just taking into account the market movement that naturally happens within, like you said, within a bull market trend line. Sometimes from 1 to 3 years is going to look a certain way. You're going to see a certain amount of movement. You extend it for 5 years or extend it for 10 years. That's when the line starts to get softer or more linear looking. But when we go more granular and zoom in, that's when we see, oh, that's right. We actually did move up and down a lot within that 10-year period.
Yeah, I think the longer term you have, the longer time frame, the less important that variability can become. Um, for example, if you're a pension fund and you're a perpetual investor, right? You have 100 years of time horizon. The day to day, the month to month, the year to year variability isn't really that important to you as long as you're well diversified. But for an individual investor, it can be really critical. Uh, an example is if someone sells a business and all of a sudden they have all this cash. Well, they may invest it all day one, but the first, the when they invest, it's really important for them to understand that the first couple of years, the month they invest, that cost basis becomes really important. Okay. So the first 2 to 3 years may look really good if they bought on a very good month, or it may not look good. And it's really independent of the manager. It's really based on what the markets are doing at that point in time. However, the longer time they're in the market, the less importance that timing, that month of their investment becomes. And like you said, as you extend that horizon out and they're invested for longer, it becomes almost irrelevant. And so, but for a client, it's very important to understand that you can go down for a few years in a row, and we're still planning for that. We're still taking that into consideration when we're looking at your financial goals, and that's really critical.
Mm. You bring up a really good point. And I've been talking to a lot of different people lately who do, you know, kind of mergers and acquisitions, or, counsel people on selling their businesses, and, these areas. And what does happen? I love this conversation of when you do sell a business, let's say you do sell and you suddenly have an influx of $30 million after taxes. We're going to pretend like it was a great sale. Maybe it was like 50 or 60. You end up with 30 million that you get to keep for your retirement. What do you look for with that person? Like what would be your recommendation from the, CFA and FRM standpoint? How would we work together, right? So I'm the CFP over here. We're going to plan for what you want and have, different buckets of, you need this for right now, you need this in 5 years. This amount can be invested towards the future. What are you looking at from the investment management side for someone like that?
So it really depends, and I'm going to give you the canned answer because it's really not canned; it's actually true. Um, and it really depends on the client. Um, whenever you sell a business, you basically own 100% of a private equity, right? And so you've taken it off the table now. So now you have the ability, based on your risk tolerance, your goals, your income needs, your liquidity preferences, what allocation should you have? When you owned your business, you were kind of forced to own that business because that's what was generating your large returns. And congratulations for an after-tax $30 million sale. That's fantastic. Um, but once you know those really relevant and important pieces of information, then you can plan. What I would say, and I think I'm getting to the real question that I think you're asking is how much would you invest? When would you invest? And my inclination, and I tell clients this all the time, is I said, look, you just sold your business you owned for 10, 20, 30 years. It was in equities. You're not, you shouldn't avoid equity risk because you just made a ton of money in the equity markets, albeit private equity markets. So what I tell them is, look, anytime you have your cash outside of the equity markets, it's not like you need to be re-involved right away. And so generally what I tell people is if they can tolerate it from an emotional and a goal standpoint, invest all the money right away in the equity market if they can have a long-term perspective.
Mm,
If the client has a shorter term perspective, you have to start modifying that investment based on what their expectations are. So, for example, like I said, it could possibly be the first couple of years that person, if the equity markets are very, very high, okay, let's say the equity markets are really, really high, okay, and it's real toppy and it's not acting well. I would probably talk to them about dollar cost averaging in, start the process, get them involved at least a little bit, and then have that commitment that no matter what happens, we're going to reinvest some of that cash over a period of time. And that could be dependent on how they feel and those types of things. But as an advisor and as a money manager, our job is to help educate them. And
mm,
I will, I tell I tell almost all the clients that do this is like, look, you need to get re-involved right away. Typically, at least in my experience, the business owners that have sold are actually fairly young relative to where they will be eventually. And so they have a lot more time on their side still. If they're 50, 60, 65 years old, they need to get re-involved pretty quickly, whether it's all in or a dollar cost average uh, budget or schematic over a period of time.
yeah. Yeah, that's exactly where I was going with that question with, and we've had this conversation with, different specific people before too. Like, should you dollar cost average or do you just go all in? And that perspective has come up over and over. Like, it really depends on how you feel. So if you're the client and you're going to really be like in emotional turmoil that your investments are kind of mm, jumping up and down versus like, oh no, it's going to be okay because I don't need that money for 30 years. So I'm not even really going to look at it that much, right? That perspective is going to shape how we recommend what's gonna be the right fit for you. Because the mathematical answer tends to be invest it now, right? Like that's mathematical,
Pure math, pure logic,
right?
no emotion.
Right. And if that's okay, like if your brain is like, well, then if that's the logical thing to do, and I've had clients say that, if that's a logical thing to do, let's do it. But then, we have to also know our clients well enough to say, "Hey, this happened last time we went through a rough patch. You responded this way. How are you feeling now? And how is that different from, when you responded differently before? Are you going to be okay with movement in the market if we invest everything right now?"
Yeah.
So yeah.
Hannah, I had previous in my career, I've had a client that their demographic would suggest that they could be very, very aggressive, all equities all the time. Okay. But this individual, their emotional makeup was such that they really couldn't handle a lot of the ups and downs. Well, the downs, they could handle the ups, but
Right.
the downs of a large equity allocation. So what we determined in that case was we broke it into four buckets, his portfolio. We broke it into four buckets. One was his liquidity needs, meaning that's short-term cash, emergency, but that's like a savings. Like if you need the cash very, very quickly to support yourself, to buy something, that's what that bucket is. Second bucket is income. He needed to, because he sold the business, and so he needed to replace that income flow. So we allocated enough funds to replace that income from his job. Then the third bucket was legacy, meaning basically inheritance for the kids. And then the fourth bucket was philanthropic. And each of these had different structures, but they were in separate accounts. And here's why that's really, really critical. Because when we broke it out with by goal that way, the legacy and the philanthropic bucket, the client had absolutely no problem with investing it instantly for long term because that wasn't considered quote unquote his money.
Mm.
It was the kids' money and it was the charity's money. And he knew that. And he was totally fine when we went through ups and downs that those two buckets were very, very heavily growth oriented. In the income bucket, we were very, very safe. Income was pretty steady, exactly kind of scheduled the way he liked to get it. And then obviously the cash emergency cash bucket really helped because he was like, even if the equity market's down, I can live for a couple of years without taking a lot more money from the portfolio. So
I love that. I love that breakdown because it's still really simple, right? It's not super complicated. That's one of the things that can happen too, again, when you're growing a business, right? And you're focused on this one thing. And then, if you end up with, several million or tens of millions or $100 million, suddenly all of the ideas, that people can throw at you for what should you do with all that money, can feel overwhelming. And it can
it,
be like there's like too many options. Like, hey, you know what? We can actually simplify this and still have everything accomplish what you want to accomplish with it.
exactly. I mean, this individual is very, very uncomfortable with private investments because of his risk tolerance.
Mm.
But he had a long time horizon left. So, like I said, his profile, if I would just had to write it out on a piece of paper, his profile was such that he should have a lot of involvement there. Um, so when we broke it out into the four buckets, his legacy bucket, because it was such a long time horizon, he had absolutely no problem investing. And he made a tremendous amount of money on those investments over that long period of time. But again, he had to frame it, he had to mentally account for it in
Mhm.
his mind that to help him tolerate those volatilities. So it's just, it's one solution we came up with. We've used it with a number of different clients, and it really does seem to work when people are very nervous at the outset.
Mm. And in the CFP literature, that's literally called mental accounting. Like that's what that is, right?
Yeah.
It's giving yourself the ability to say this money, it's all money, right? If you had $10 million, it's all $10 million. But if you give yourself the ability to break it out into this bucket is for a certain thing, this one's for something else, that mental accounting um is our nervous system's way of, creating space to be okay with movement. And so that's partially a behavioral finance piece, but then also just like the acknowledgement, like you said, of where are you at on the risk profile side, and how do we then build something that fits for what you want to accomplish and honors like the fact that we can move with market cycles and we can be really um, have powerful strategies that will work over time. So I love that.
Yeah, it seemed to work for him, so we've used it with a few others.
Yeah, and that the other thing that I wanted to bring into this conversation, so kind of like veering off of that for a moment, which I think is super valuable for especially for our audience who a lot of them are business owners. I wanted to talk a little bit about inflation, which is also crucial for business owners to understand. But one concept that I think I've seen talked about, it's kind of in the zeitgeist, when we talk about disinflation and the inflation numbers coming down, and the disconnect between people thinking that that means prices are also coming down. And I don't think we talked about this last time because it wasn't part of that conversation, but, gas prices being a really an interesting example because their prices do go up and down, right? When a
Yes.
barrel of oil gets cheaper, the price of gas eventually comes down as well. But that is not typically the case when we look at food in the grocery store, or the price of, vehicles or, anything like that where,
Or
the things that
housing prices.
housing prices. Um, we're not necessarily seeing corrections to what we might think of, okay, if the price went way up, it should come back down. That's what that means, right? No, it actually doesn't mean that. When we see lower inflation or disinflation, that's still more than zero. The price is still going up from what it was before. It's just at a lower rate. Yeah. So can you talk about that for a little bit?
Yeah, that's actually I dedicated 3 or 4 slides or pages in my 2024 look ahead because um, part of this whole rally over the net since basically 2020 to now has been people feeling terrible about the economy and about their own financial situation, even though we've had a strong labor market, we've had strong wage growth, we've had strong equity market returns, but yet people aren't feeling it. They're feeling terrible still about their situation. And I think you've nailed a couple things right on the head is disinflation means that the prices are growing, but at a slower rate than they were. Okay. Deflation is when prices are going down. So using gasoline prices as a good example, gasoline prices are really, really volatile and they can go up, i.e., inflation, and they can go down, which is deflation. So they inflate and deflate quite a bit actually over a period over a cycle. And so one of the things that I think people and consumers and are feeling is that yes, inflation is coming down on an annual rate, but the cumulative effect over the last 3 years isn't coming down. It's still there. It's just growing at a much slower rate. Our calculation was, I mean, essentially, if you take wage growth, subtract out inflation, cumulative over the last couple of years, you're about 22% in the red, meaning your income, unless you got a 22% raise, your income is providing less or buying less than it was 2 to 3 years ago. And that's a big deal. That's where you see that in the narrative with the election cycle. That's starting to become a big deal. Because that cumulative impact is really, really critical for US households. Because if you're going to the grocery store and you used to spend $80 a week and now you're spending $140 a week, that's a big deal. That does crimp your consumer discretionary spending. You're spending on entertainment, vacations, school clothes, all of those things that are necessary. Um, but you have less money to purchase those with. So um, that cumulative effect of lower real wage growth is really is starting to weigh on households, which is one of the reasons that we think first half this year economic growth is going to kind of bounce around zero, and then start to accelerate here at back half of the year as the Fed lowers interest rates.
Mm.
But it's still going to be a little bit of a slog, um, for households to get back to where they were in a purchasing power effect because it takes a while. Wage growth still around 5%, inflation's around 3, so we're making it back up. but it's going to take a number of years to get back to the point where we actually feel as wealthy as we did a couple of years ago.
Mm, it's so interesting. And I think that point gets missed or buried in the just the normal course discourse on the subject, that over that time frame, like you're saying, that cumulative amount is really um, a powerful number to look at and to understand why you're feeling the way you're feeling. So yeah.
It it's also really important, like when you're doing financial planning, because what people forget is if you have a long time horizon left, even if inflation is 2%, which is the target, very low inflation, but if it's 2% and it's 10 years, you better have a plan to make up that purchasing power difference. So
Hmm.
if you're all in bonds and you have 30 years left of life, presumably, um, and inflation's 2%, you're going to have to make up that difference. Because the dollar you're spending today is not going to be worth what it is in 10 years. And so it's one of the reasons that we talk to clients about, if you're young enough, you need to have at least a minimal amount in equities to keep pace with that inflation rate. You know, generally it's 20 to 30% at a minimum just to keep pace with that inflation. Now, again, that's a very long-term thing, but it's something that consumers and clients and prospects and everybody who's investing needs to consider.
Yeah, that piece is always crucial. It has to be built in when you're doing forecasting for the future. So that's a piece. When I do planning with clients, we're using kind of around 2.5% is what we're forecasting over a long period of time, and it's pretty interesting to see what that ends up looking like, right? If you let's say you spend $100,000 today, by the time you're in your 40s, by the time you're in your 70s, that same amount of money is like, you know, 300 to $400,000 that you are spending on an annual basis to be equal to those dollars spent today. And so that's the kind of planning we're doing. You can't assume that, well, if I spend $100,000 today, then I'll be spending $100,000 in 20 years. Like, that you're gonna be pinching pennies. Um,
Yeah.
if that's the case, and cutting back on a lot of different things, if you literally are planning to spend the exact same dollar amount. So having the same purchasing power is what we're actually looking at over your lifetime. How do we keep you in an equal purchasing power over the next, like whatever your time frame is. Like you said, 30 years, 40 years sometimes. If someone wants to retire at 55, we're going to plan, for at least 40 years of retirement
Yeah.
at that point. So, yeah, that's a really, really good point. Thank you.
Yeah. It's like I tell people that if you have a long time horizon left, really your biggest risk is inflation, purchasing power decline. So we gotta plan for that risk first. And then
Mhm.
we can do some other things. But
Love that. Well, we are good for this week. We want to wrap up here. And as always, if you have any questions, if any topic is like coming up that you want to hear more about, or, you've been wondering, anything on the investment side, the financial planning side, send us an email. We shared that earlier, and it'll be in the show notes as well. And put podcast question in the subject line so that we can find it easily, and we will be sure to address it on another episode. So thank you, Brad, as always, for being here. I appreciate you.
you're welcome. Appreciate you. Thank you.
Bye for now, everyone. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com, and tell me about it. And if you're ready for your greatest expansion,
You can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.